Welcome everyone to Quantel's yet another webinar. This time it's a very deep subject that interests a lot of people who have been having career in large firms, now acquiring quite a lot of stocks offered by the companies, even purchasing stocks using the employee stock purchase plans. So many folks that we work with as clients, uh, they all have this particular question in mind is like I've got these many stock, my wealth is defined by this the performance of one particular stock. How to de-risk it? If I de-risk it, there's a huge tax implications. How to avoid the tax implications, and so on, right? So this is a topic dear to a lot of clients, particularly as their wealth grows over a period of time, and many of these stocks have multiplied in value over 10, 15 years. And we are going to dive deep into the subject. So my name is Sreenivasan. I'm the CEO and founder of Quantel AI Asset Management. So at Quantel, we use deep tech, AI, and quantitative finance to design strategies specifically for adapting to the market conditions and to dynamically hedge the portfolios to exploit market in good conditions and also defend or preserve the capital if the market conditions are bad. So this kind of hedge fund like strategies that we offer, we democratize that to pretty much any and every investor. So that's Quantel AI and Quantel Asset Management in a nutshell. And I would like to introduce Jerry Yuan, our panelist here. Jerry is a senior quant finance analyst, engineer. He's been doing a lot of quant research. Prior to him joining at Quantel Asset Management, he is a primary designer for our algorithmic trading solutions in Quantel. So we'll get deeper into the subject here, and we're going to feature Jerry and some members of the team going forward to get into the subject matter expertise. Okay, with that, let me get started with welcoming Jerry. Thank you, Jerry, for coming.
Thank you.
So,
Hey, Shyam.
yeah, let's talk about what is the issue here, right? So let's say that I have a client who has worked in a company like Microsoft for 10 years. And over the 10 years, the company is giving RSUs that gets vested into the company shares. During the time, the employee is also purchasing the Microsoft stocks. It keeps going. But as you know, Microsoft hasn't done well in the last 1 year. So the portfolio is kind of stagnant. And in fact, it's dropped almost 20% in just this year alone, in 2.5 months here so far. So there is clearly a risk in having a single stock exposure when somebody establishes a career in a company, right? And this can be one of any of the companies. It doesn't have to be Microsoft. It could be tech companies. It could be finance companies. I used to work at Morgan Stanley for many years. I used to get a lot of stocks as part of the compensation plan. So this problem is there everywhere. Some people see it as a problem, some people don't see it as a problem, but there is inherent problem from a quantitative point of view. Can you explain, Jerry, what is the risk here of having a single stock exposure in a big chunk of your wealth?
Yeah, so I think that's the real problem across a lot of ESOP clients. I think the main risk is, it's very high concentration in one single stock, right? A lot of clients we are facing, they have almost, you know, 70%, even 80% of their total net worth, concentrate on their employer stocks. So if the majority of the net worth tied to employer stocks, it's very risky and volatile, right? First thing is you have career risk, and second, the investment risk. Both of them, they are highly correlated. And the next issue is the performance will be heavily linked to one company. For example, the client having around 60% of net worth that's invested in Microsoft. So last year, Microsoft only merely around 1%, 0% return. This year, dropped more than double digit, right? So the issue is, the first thing is concentrated risk. Second is emotionally you will not feeling so well, right? When to sell, or maybe you don't want to sell due to loyalty or other reasons, or sometimes you will have the risk of fear of selling too early, right? So a lot of things will happen during the years, and for that we don't know. So that's why I think a lot of clients come to us to try our solutions. Yeah.
Great. Thanks, Jerry. So this is a problem that will be there unless we try to tackle it at some point. It could be post retirement, because no matter what, if the company stays afloat over that course of period, because a lot of companies have gone down the drain, right? I'm sure
Yeah.
it won't happen to any of the big large cap stocks that people generally consider. But if I happen to work for a mid cap stock and it may not survive the 20-year period for whatever reason, and my wealth also just disappears, right? So even if I have a large cap stock, it is a problem of capital gains accumulated at some point. One is I've got the single stock risk, but two, I also have the tax implications that need to be carefully untangled, right? So can you talk a little bit about that? If I don't do anything, what happens? And if I want to do something, what happens?
Yeah. So for example, the most the first thing coming to my mind is, if you hold only one stock, especially the employer stocks, right? There's no tax efficiency at all. What if you need an emergency fund for buying a house or other things, right? Then you cash out one time. What happens is you have huge tax, uh, you know, maybe your total capital gain is around the 60%, even 80% if you work for the company for more than 10 years, right? The capital gain is huge. So uh, a lot of clients, they don't want that kind of solution, right? So
Hmm.
first thing is you miss the opportunity. Holding one stock, you miss the opportunity to convert the volatility into other gains. For example, last year, Magnificent Seven, end of the year, they are not performing so well. What if you have to work, you are working for this company? That's the first thing. All right. Second is maybe you lose confidence and you want to cash out some of this position.
Hmm.
It's very painful, right? You have huge capital gain, at least more than 50%. I would say most of our clients more than 50% capital gain. What should we do with this tax, right? So it's a heavy burden on the year-end tax. I would say you will pay a lot for that. Yeah.
Got it. Okay. So if I don't do anything, clearly there is a huge risk that I have to at some point tackle with paying the capital gains at some point. Even if I keep it till the end of my life, my children or whoever that I give my assets to have to tackle that problem, right? So,
Yeah.
what is the solution if I want to address this risk issue as well as the tax gain issues? Clearly, there is a solution out there. Can you talk a little bit about what is that solution and how we can mitigate? If it, I understand that it cannot be completely removed, but can you explain a little bit on the details of how to reduce the risk without taking too much on capital gains, or is there a way to reduce my capital gains impact on this?
Yeah. So what we typically doing is, cash out these ESOP stocks gradually and move to our tax loss harvest strategies like direct indexing. So after we reduce these concentration position, it's not one time thing. Okay, so for example, you have maybe 1 million invested in your employer stocks. We gradually remove these. We have a plan for that 2 to 5 year window, and gradually move them out to our tax loss harvest strategy, and that is tailored to the benchmark. If you want to be more aggressive, it can be Nasdaq 100, or let's say just use SP 500 as our benchmark. So you will benefit from the market return, but at the same time, because we are doing direct indexing, we're holding these 500 stocks directly. And by actively manage these losses, what we can do is we will find these losses on your holdings and cash them out, and using other similar um, asset to replace these lost stocks. So these have unrealized gains position we will never touch. But for these losses, we can harvest these losses during the year. So at last, what you will see is you maintain the market exposure through the similar asset, but at the meantime, we are realizing these losses during the year. And we can save these losses for three part. We can use that to offset. First is
So
your ESOP gain, right? Yeah.
right. No, just
You
I
have an
want to hone on that particular point. So what you're saying is, if
mhm,
let's say I want to mitigate the risk of a single stock exposure, and I say, okay, fine.
yeah,
During that point that I'm trying to mitigate the risk, I'm okay to track an index like S&P 500. Last year, S&P gave 17% return. The year before, it was
yeah,
20% return, and so on. Suppose I'm okay to, get a S&P equivalent return, but along the way, I can take some losses on the books while not compromising on the return. That's what you're saying, right? So
yes,
I'm
yeah,
tracking, I'm not compromising on the return to just acquire losses. Because when you think of losses, I don't want to lose money, but on paper you're losing money, but in reality you're actually making money. Can you explain that a little bit?
yeah. So how it works is like we instead of I think that's the next topic we can deep dive is instead of holding this ETFs, right? For example, what maybe some of them is saying, okay, it's just like cash out my position and move to SPY. This is not how it works, right? So what traditional ETF works is it's like buying index in one security, right? So
Mm-hmm.
there's no tax harvesting flexibility at all, right? If you, for example, some of these positions you're losing money, but finally you still see, okay, you make 16% return from the ETF from this SPY ETF, for example. But actually, under these ETF, these 500 stock holdings, maybe 40% to 60% of them are losing money every
Mm-hmm.
year, right? So what we are doing is we hold these 500 stock directly and harvest these losses, replace them with other portfolios, other similar equities. So going forward, you still maintain the SP 500 exposure, but we can harvest the loss, right? So it will not make okay, maybe some people will worry that if you're doing that, will it reduce the return from 16% to 10%? It will be merely affected because we have the similar exposure, always have the similar market exposure. But at the meantime, we can harvest a lot tax during the year. For example, if the market is down a lot, maybe we can harvest 15% to 20%. Even the market is up 70%, sometimes we can harvest around 10%, even 15%. So that's
So
how it works.
let's take a concrete example to just give a number to that discussion, right? So
Yeah,
suppose I have a $500,000 portfolio in Microsoft stock as an employee that I've acquired. Let's say 50% of it is capital gain over the
yeah,
10-year period that I've acquired it. So 250 is my money, and 250 is the company's, the capital gains on the vesting of the stock and all those things, right? So now, if you say of the 500K, I can tax loss harvest 15%. So 15.5 is $75,000 worth of harvesting you could do. So that's basically I can erase the capital gains on Microsoft up to 75%. That means, sorry, up to $75,000. That means to the extent of 20% of $75,000, which is close to $15,000, I will save. I don't have to pay $15,000 extra tax in this case. If I did nothing, I would have paid extra $15,000. But because I'm harvesting, you're saying by just using smart financial engineering, you can save $15,000 on your tax bill. Did I
that
get
will
the math
be
right?
Yeah, so that's a very simple math, but usually we need to do case by case, right? For example, these usually we will not sell that 50% one time, right? We gradually reduce the
Right.
exposure
So
over
it's a careful
year.
engineering
Yeah,
that you
yeah,
would do. It's not like a single shot sell or buy. You have to do it over a period of time to carefully unravel the capital gains impact of it to reduce it and so on.
Yeah, and also that's embedded with three, as I would say, these systematic approaches based on three dimensions. First is the vesting schedule, right? Is that
Mhm.
vest over 5 year or 3 year, right? Or do you have new vesting? Second is the tax planning considerations. So it's very 100% customized. Third is also based on your employer, right? The market conditions is that the it's a new business circle for your industry, or is there any potential risk for your company, right? We are also doing some analysis on that, and also how much amount allocate to the direct indexing should be based on the existing plan. You see what
Right.
I'm saying? So, but approximately, I would say every year for these direct indexing portfolio exposure, we want to achieve around 10% to 15% harvested loss. So your math is correct, I would say. Yeah.
Got it. Okay. Thank you very much. Yeah. So, coming to Quantel's offer in terms of what we do for our ESOP clients, when they come with these big, large exposure, from a financial engineering point of view, can you explain what your team does in creating these portfolio of direct index stocks, and what do you do on a daily basis to look for the harvesting of opportunities of the tax losses, etc.? Why is this different to, let's say, off the shelf kind of solution that you could find in, let's say, a robo advisor?
Yeah. So the first thing is we are using the technical term is, the direct indexing. So under these portfolios, you will see almost you hold 500 stock on your account, and
Hmm.
each stock finally become an independent tax slot, right? So for example, every month, every week, we keep tracking these stocks, and we find maybe January 1st, we start these planning, start this strategy, and end of January, let's say maybe February 1st, we find 20% of these stocks have losses, and
Hmm.
it's let's say it's contribute to the total amount you invest in. Let's say let's say we invest 1 million in the direct indexing, and these losses will contribute around negative 1.9% losses. We
Hmm.
harvest them immediately and move to other similar stocks. Or if we think the current market condition is not so good based on our systematic approach, we have other tools, other asset to park this money. And 1 month later, we move the stock back. So it can avoid your worst sell. That's the first thing. Second, we have can harvest these losses. So for example, this year, right, 2024, there's 2 months that have you can harvest a lot loss during the year. One is January, one is during July time, August time. So that we are doing that not just at the year end. A lot of financial advisor, what they do is okay, hold this position until the end of the year. They do just
Hmm.
one time tax loss harvest, right? So it's just like totally it's random. You don't know how many losses you can collect at the end of the year. But if we do more active management, we are able to create more harvestable losses during the year.
Right.
So
So in a sense,
yeah,
when a stock holding goes down, typically our reaction is we sulk on that day, right? We just, oh,
yeah.
it's too much of loss on that day. But in this particular scenario, you're actually happy, right? That there is a huge loss that you can actually harvest while still trying to maintain the returns of the index as a whole.
Yeah, the good news is sometimes a lot of people are afraid of collecting a loss. I mean, they are worried about something like, okay, if they sell these stocks, will it bounce back, right? But
Right.
if we are doing on the 500 stock level, what happened is the portfolio's return will not be affected too much because you
Right.
have either usually on average only I would say 5% to 10% of stock will lost month by month. So you still have 90% exposure to the market plus we will replace these holdings with other similar stocks. So the
Right.
total exposure to the SP 500 will not change.
Right.
Second, we are not blindly replacing them with similar stocks. We have other asset, equity, or other choice that kind of like a hedge. So finally, we can collect even more alpha from these,
Right.
not just tax alpha, also this alpha from the trading. Yeah.
Right. So looks like it is a case by case basis. So if somebody has got a Microsoft stock and somebody has got a J&J stock in consumer goods, for example, you're going to have a different approach in terms of when to liquidate, what to liquidate, how much to liquidate, etc. It's going to be a very, very different kind of a solution on the liquidation aspect of it. But once something is liquidated, the entry point of like these harvested, uh, like the tracking of the index and all those things could be similar, but still, it's a case by case basis in terms of how it's managed. Is that correct?
So we can break down into two parts. So for your existing position, how we close that is case by case. But once you move to our direct indexing portfolio, that's the same bucket. So that's 100% managed systematically. So
Right.
a lot of clients, they are sharing the same bucket of strategy. So the execution logic will be the same. So you will not see, okay, one client have a better return, you have a worse return. But once you start these I would say once you start these portfolios, the return going forward will be the same on the direct indexing. Yeah.
Sounds good. If you have any, you can also reach out to us separately. But if you want a personalized analysis of your situation, your holdings in ESOP, please do reach out to us and we can definitely take a free look at what your holdings are and what we can do to mitigate the risk as well as the capital gain situation there. So moving on, specifically with respect to the direct indexing, you mentioned close to like 15% can be achieved, but that goes with the assumption that I start early on in the year, because no matter what, the
Yeah.
year ends on December 31. So the later I join this program, the lesser for that tax year I can achieve, right? Because it's an ongoing process. Is that correct?
Yeah, so it's also based on market condition, I would say. For example, 2024, 2023, if the market is mainly driven by the large cap Magnificent Seven,
Mm-hmm.
typically you will be able to harvest more from other small cap stocks, mid cap stocks in the SP 500. The small
So
cap
the
is
more
compared to
volatile it
these,
is, the
yeah,
more tax loss
yeah,
harvesting you can do.
yes. So it's every year have different market condition. For this year, what our projection is, probably we will be able to harvest more because these Magnificent Seven stocks, actually the first month is performing extremely bad. So um yeah, so this year definitely it's a very good year to start tax loss harvesting. Yeah.
Got it. Got it. Okay. So moving on, in terms of the tax loss harvest situation. So when you replace the stock, when you get out of a stock, clearly you've got cash there. So you got to invest the cash or just keep the cash as is, right? Again, depending on a case by case basis, it's the strategy will decide whether to keep the cash based on market conditions or to find an alternative. Let's say you get out of an S&P name like Amazon, right, with your basket. So if you have loss in Amazon, you take it out, but then you need to find something similar in Amazon to get the performance of S&P 500 on your basket.
Yeah, so that's like what I said before, right? There's two choice. One is actually there's three choice. So one is using the similar security to replace that. Second is based on our approach, probably we will hold cash for that position for 30 days. Third is we can use other forward index product to replace this position. The reason
Mm-hmm.
why I'm saying that is because this, for example, let's use 2022 as a example, right? The
Mm-hmm.
market is trending down, and if we use these similar security to replace, actually you will experience a similar drawdown as market. But during these extreme conditions, if you hold cash, you still harvest a loss. But from the strategy level, actually, you hold more cash as like a dry powder, and later you will see less drawdown computer market
So
during
potentially
these
I can
extreme.
even better the
Yeah,
S&P 500
yeah,
return on the
yeah.
underlying basket.
Yeah, so for example, maybe just 30 days, for example, you find these positions they have lost, and our system think, okay, it's not time to move to similar equities or the body index product. We will hold the cash. Just 1 month, it will make huge difference. Okay, so
Okay.
the market keep dropping, but we have less exposure to the index, right? So during that conditions, that 2022 will definitely outperform the benchmark. Yeah.
Got it. Got it. So when it comes to like a typical client, right, who would benefit from this? If I have only a $10,000 company stock, clearly there's not much of benefit there. But what is a typical profile of a client that you can talk to here in terms of who can benefit from this tax loss harvesting
Yeah.
solution?
Yeah. So I think we talk a lot about these scenarios, right? So that's what we uh, use as an example is this client that have around 500K in Microsoft employee stocks and around 50% embedded capital gains. So definitely it's highly concentrated in a single name.
Hmm.
For his investment is highly concentrated in that single name. So and we talk with client and see there's a lot of ongoing investing in the
Right.
near future in next 3 years. So what we do next is we need to customize the solution for him. Okay. That the first thing is the multi-year diversification plan, right? We don't want to cash out these stocks immediately. So we gradually reduce the Microsoft exposure over time. And how do we cash out? It's what I said before. It's based on the vesting schedule, your tax planning consideration.
Hmm.
Third is the market condition, the microeconomy, and your industry, right? And then we allocate to the our direct indexing portfolio. So
Hmm.
these two steps are separate. The customized step is how we cash out your portfolio. And once these money move to our portfolio, it's systematic and across the board, every client, if they invest in this portfolio, ideally, if they start at the same time, for example, we have different starting point. Every month, first trading day, this group of people start doing the same direct indexing. So this group of people should have the same performance. Okay. So once you move to this portfolio, we are doing the tax loss harvest. So for this projection, the how much amount we can harvest this year, probably it's around 10%. But we do see a lot other year, 2022, you can even harvest more because market is dropping, right? So this systematic approach will generate the recruiting tax assets annually. Yeah.
So in a sense, you're capitalizing even in a bad market year. Overall, from a personal wealth point of view, if I use that year for capital tax loss harvesting, I would have made myself good with this scenario. Even though the portfolio goes down or the market goes down, but I've taken it to the advantage of reducing my tax implications because tax is a big part of any of
Yeah.
the considerations here. Is that
Yeah.
correct?
So it's like, it's case by case, for example.
Hmm.
Maybe some client, they worry about the market going down, right? But somebody, they can use this year to realize the gain and use our strategy to harvest the loss, offset the gain from this ESOP exposure, right?
Right.
So
Sounds good. And I guess you would provide a monthly report of how much of tax loss was harvested on a monthly basis, and so that you
yeah,
can have a projection of what is expected from a portfolio performance point of view, as well as the tax loss harvesting point of view.
yeah. For extreme months that drop a lot, for example, usually you can harvest around 1.5% to 2%. But for normal months, it's around 0.5% or even 0.1% to 0.5%. But
Mhm.
it's all based on our systematic approach. And so our projection is pretty broad. You can see it's from 10% to 15% because it's
Right.
vary based on the market condition. Yeah.
Got it. Got it. Okay. So I would love for the participants to ask questions with respect to their personal situation. You don't need to name the company, the stock that you're holding, but just if you want to throw out your question that you want to ask, please do so on the Q&A part of the webinar here. So I have a couple of questions here. One is a robo-advisor like Wealthfront also offers direct indexing at much lower fees, 0.25% fees, right? Our fees runs around 1% in Quantel on an average. How would Quantel stand out in what is a differentiator in your strategy versus Wealthfront strategy as an example?
Yeah, so it's like, yeah, I think Wealthfront will not be I know Wealthfront, they are doing some tax loss harvesting, but we are not competing with them, I would say. Because, a lot of traditional advisors, they are doing the same thing. They just invest in these S&P 500 stocks done to keep doing the active management until year end. And what they do next is around the December time, they cash out these loss. They just do one time tax loss harvest. So their projection is usually around 3% to 5% loss. But why we can achieve maybe 2 times losses? The reason is we more actively traded. But some people may ask, well, that does it mean it will have more commission fee or you know trading costs, right? So it do have more trading costs, but um, that's it's like a trade-off, and we
Right.
have the internal optimization. So it's worth doing more active trading than holding to the year end to do these tax losses. So I don't think we can compare with Wealthfront or other
Yeah,
financial
there's different
advisor.
levels, as you
Yeah,
said. I've heard even hedge
yeah,
funds do 30 to 40% of the initial portfolio value in tax loss harvesting, but they take enormous amount of leverage and risk alongside with
yeah,
it. So
yeah,
doing long short strategy and all those things comes with a huge amount of risk, and we don't take that kind of a position here. Is
yeah.
Okay, the other question that I have here is does this assume you need to have capital losses in other parts of your portfolio? I guess I can tell the answer is look, yeah, it has to be, right? The whole purpose is to erase some gains from somewhere else with the tax loss harvesting. Right, Jerry? So this
So
assumes the
that's
whole tax loss harvesting is a situation when you have so much of capital gains, some other part of your portfolio, you want to remove those capital gains from the portfolio. Otherwise, why would you accumulate losses?
so three part, I would say, not just the capital gain, right? For example, if we do it on the first couple of months of the year, we project that in the near future we will have gains, right? You need to prepare for it. All right, for
Mhm.
extreme good year, right? Probably you will have a lot of gain, and also based on your vesting plan, right? If you want some emergency fund, right? A lot of people what they do is they have the vest and they immediately sell these stocks. Then
Mhm.
what should you do, right? So for the future portfolio gains, we also need to do the projection and not just the realized gain, right? Third thing is everybody have up to 3,000, you know, tax, you can deduct. So that's the third part, right? So
Got it.
yeah, not
Got it.
just
Wonderful.
realized. Yeah,
Sounds good. Clearly, there is a lot of details there, and that depends on individual stock that our clients have, and a discussion around how much is the capital gains. What is the total size of the portfolio? How long do we have to remove or mitigate the risk that we have, as well as the capital gains impact that we have? So we welcome all the participants here to schedule a time with the Quantal team to be able to discuss your personal situation, and that would be a free call. And then based on whether you want to proceed with it or not, you can always get into a tax loss harvesting strategy with Quantel. Thank you very much. Really appreciate your time, and we'll see you in the next webinar. Thank you. Bye. Thanks, Jerry.
thank you, Shyam. Bye.